It's Friday, 23rd of May. This is your Capital Economics weekly briefing. We did have an original show ready to go, but the relative quiet of a Friday lunchtime has been shattered by a Donald Trump posting on Truth Social, threatening to impose 50% tariff rates on the European Union on the 1st of June. Now, this comes well before the expiry of that 90-day pause on those Liberation Day tariffs. I've got Group Chief Economist Neil Shearing with me. Neil, what does this all mean?
What does it all mean? We thought we'd wrap the podcast and then this news breaks. Typical, isn't it? Look, I think a lot of it depends, doesn't it, on whether or not this is Trump trying to play bad cop to Scott Bessent's good cop, and whether there's any substance to this threat or whether it's just a tactic to apply some pressure on the EU and to get negotiations moving. It does seem that in classic European style, these discussions between the EU and the US have got bogged down a little bit in bureaucracy. The EU drafting terms and letters, and clearly the US wanted to move faster. And as we've talked before, that's not really in the EU's DNA. It tends to move slowly. It tends to govern by consensus. So perhaps we're seeing some of those tensions come to the surface. And perhaps this is a way, I think, of Trump trying to move things along. So I think at this stage, I would probably tend to view it in those terms, that it's not necessarily a serious threat so much as a tool to try and progress negotiations. But it does raise the question as to what this would mean. We've got our tariff impact model that clients can find on our website. Actually, it's a good example of how this model can help at times like this, just to act as a check on what policies like this might mean. For what it's worth, the tariff impact model says that Ireland will be by far the hardest hit by a 50% tariff imposed by the US. That's because of its large pharmaceutical exports to the US, possibly a hit as large as 4% of GDP. Germany and Italy, smaller but still substantial, about 1.5% of GDP. France, a bit less than 1% of GDP. All of these are changes in GDP after a 3-year period. And then, of course, in Switzerland, it really depends upon Switzerland's outside the EU customs union, so not directly affected by US tariffs. But if it were to get the same treatment, then it would have a hit similar to Ireland. So potentially quite a big deal for the EU in terms of economic hit if this were to materialize. But that's the big question, isn't it? Is this just designed to put pressure on European leaders?
Given the skimpy nature of those agreements that the US struck with the UK and with China in a hurry, it should be said, you would imagine that in Brussels, this would train thinking on perhaps getting something similarly done with the US rather than getting bogged down into the details of a very comprehensive trade deal.
That's clearly the way that the US wants to run things. And if you look at how the deal was done with the UK, for example, that conforms to that idea, that model, doesn't it? That you have a kind of agreement in principle, memorandum of understanding, whatever you want to call it. It's certainly not a full and comprehensive deal, but it provides some certainty to firms and to households and allows the rest of the world to move on. So that would be the best way of progressing, I think. But it's not really within the EU's DNA. And this, as I said, is something that we've discussed before, isn't it? That they move slowly, they're governed by consensus, they work and operate within the rules-based global trading system. And that's a complete anathema to this Trump administration.
I mean, for me, the big takeaway here is it speaks back to this message that we've been telling clients since that US-China agreement. And that was basically, don't get complacent. Much can go wrong between now and the expiry of these pauses on higher tariffs.
Exactly. I think that's exactly the point. A lot of our focus has been on how the US and China deal could fall apart. But we did say this time last week that there's still the deals with the EU in particular will be difficult to do as well. And I think that this is the manifestation of those challenges. We're seeing that play out right now.
Neil Shearing there on the latest surprise from Donald Trump. Look for that tariff impact model that he mentioned in the podcast notes. I've also added our response to Trump's threat to the EU. And now back to our regular programming. Here is the discussion I had recorded with Neil earlier. Good. It's been an interesting week, hasn't it? Donald Trump's one big, beautiful tax bills passed the House. The 30-year Treasury yield is now over 5%. Bond investors don't seem to like it. Does this all signal that the bond vigilantes are back?
It looks like that on the surface, doesn't it? Particularly when you look at the long end of the curve. We've been arguing for a while that we thought that market expectations for Fed rate cuts
this year were a bit too aggressive. At one point, the market was pricing in 3, 4, 25 basis point cuts in the Fed funds. This year, we, of course, in our forecast, don't have any. Those have now broadly come out of the market. So you've seen the short end shift up, but it's really, as you say, the long end of the curve where a lot of the action has been, with the 30-year now over 5%. And I think that is down to concerns over the fiscal position. Yes. Now, does that amount to a crisis at this stage? No, I don't think so. Is it a crisis of confidence in the US government? Don't think so. But we've come through a period where the term premium on US government bonds has been extremely low, and actually for most of the period since the pandemic, even been negative. If you look at the 10-year part of the curve now, the term premium is pushing 80 basis points, having been, as I say, negative. So it just goes to show that I think there is some concerns in markets about fiscal drift in the US. And this big, beautiful bill, not quite so beautiful, I don't think. It will only add to those concerns.
Talk about the bill is now with the Senate, and they'll play around with it, probably water it down, and then send it back to the House. What do we think it's going to do to the US fiscal position?
In a sense, it depends whether your glass is half full or half empty. This big, beautiful bill, as Trump keeps calling it, actually, I don't think it's going to add much to the deficit once you add in the projected revenues from tariffs. Now, I think aim off some of those revenue projections from tariffs, because they might end up getting diluted and perhaps not bringing quite as much as certainly some of the more bullish forecasts from the members of the administration. But we think by and large, the tariffs might raise revenues equivalent to perhaps 1% of GDP in each year over the coming years. And that would be broadly enough to offset the additional cost of some of these tax cuts. So the overall federal budget deficit is likely to be, I think, broadly stable over the coming years, despite this big bill. But the point is that it's broadly stable at 6.5% of GDP or thereabouts, and the economy is at full employment. So this is not like, for example, in 2010, 2011, when the US and other major advanced economies were running large deficits, but they had high rates of unemployment. And so you could grow your way out of these deficits and narrow the deficit through growth. At the moment, because the US is at full employment, this deficit is largely structural. It's a fundamentally different proposition. I think that's why we've started to see this reaction at the long end of the curve.
You said just now that this doesn't signal any loss of confidence in the US government, but there is this prevailing notion that perhaps some investors at least are losing faith in this government, that there is a loss of faith in dollar assets. Technically, we're still in the midst of Trump's trade war, much to play for there. Elsewhere, the US government's signaling that it's basically done with being the world's policeman. And we're at the end of a week where we've seen the dollar selling off again quite aggressively. So is there a sense, do you think, that perhaps we might be seeing a structural loss of appetite for dollar assets?
I think that's probably overdoing it a little. I think one of the problems with analysis around fiscal policy more generally is some of the terminology often conceals more than it illuminates. So we talk about fiscal crises and we talk about losses of confidence. And all of that sounds quite serious and significant. I don't think this is a kind of crisis per se. But I do think that if you look at parts of the yield curve, you look at parts of the bond market, you can see concerns, investor concerns building about the US fiscal trajectory. So I don't think it's a fundamental loss of confidence in the US, but I do think is growing concern about, as I say, this structural deterioration in the US fiscal position and what that implies for the trajectory of debt over the long term.
So maybe not a crisis, more a slow car crash.
I think if you're after a metaphor, that's perhaps an apt one, yeah.
I want to stay on this, but before we do, just very quickly, I want to talk about alternatives to the Treasury market. Our colleague Hamad Hussein's up in a bit talking about what's been driving gold this year. But I want to ask you about the Eurozone bond market specifically because our Future of Europe series is still running. I know you've been talking to clients all week, both on the continent and online, about this year's swing to Euro optimism from the pessimism that we started the year with and whether that optimism is indeed justified. So give us a sense of what you've been advising in terms of Eurozone bond market dynamics. So the supply side, the demand side, what's the message there?
How long have you got? Because there's a lot more gone, right? So on the one hand, you have the fiscal relaxation in Germany and the extent to which that's a blueprint for other countries to follow. And then you have to factor in how the ECB might respond to that. And then you have to consider country level dynamics elsewhere in the Eurozone. Now, on Germany, we obviously had that wobble at the start of the Merz government, with Merz not being elected in the first round of voting as chancellor, now in place, but perhaps the government's perhaps not quite as stable as might have been anticipated. I think the fiscal reforms will by and large survive, but it's a reminder, I think, that the government itself is perhaps not as strong and as stable as many in the market had assumed. The fiscal reforms themselves will expand the deficit by about 1 to 1.5% of GDP over the coming years, we think. Part of that's defense spending, part of that's infrastructure spending, and that will boost German GDP growth to about 1%. So up from about 0.5%, something like that a year. So on the face of it, that doesn't sound very much, but bear in mind that the German economy itself has not grown for the last 5 years. So a bit of an improvement there. Now, how will other countries respond? Well, I think the answer is they probably won't. And that's because there's relatively limited scope for other countries to loosen fiscal policy, as Germany has done, because the public finances of most economies are not in as strong a position. In the southern and peripheral economies, public finances are in a much stronger position than was the case, say, 10 years ago. But debt's still quite high and governments are still pushing to keep it on a declining path. Then you have the major challenges in the other two large economies in the Eurozone, France and Italy. In Italy, the debt burden is large but broadly stable, but only because the debt to GDP ratio is high, but we think will probably be relatively stable over the coming years, but only because the government is going to pursue relatively tight fiscal policies. And then in France, the deficit kind of pushing 6% of GDP. Debt to GDP off on a high and rising path, such that it will be perhaps 130% of GDP or so by the start of the next decade. So fundamentally different fiscal positions in the rest of the Eurozone, which means that other countries won't really be able to follow in Germany's footsteps. So the ECB, therefore, still in easing mode, we think, and there's not going to be this big fiscal expansion replicated across the Eurozone. So perhaps deposit rate coming down to 1.75% by the end of this year. That will lead, I think, to a bit of a decline in bond yields across the continent. So the ECB cutting to perhaps 1.75% by the end of this year, that's largely priced into markets now. So I suspect if you look at, say, the 10-year bond yield, it will probably end the year broadly where it is today. That is to say, around 2.5%. It's kind of 2.6% as we speak. Our end year forecast is 2.5%. That is to say, broadly unchanged. The thing to keep an eye on, I think, is France, the extent to which spreads in France might widen. If there's a wild card coming in Eurozone bond markets, I think that's where it might happen.
So putting it all together, it does sound like there's a world of fiscal risk, isn't there? To be clear, the surge at the long end that we started talking about at the beginning, and we've seen similar in recent days in the UK, we've seen it in Japan. Liz Truss was in the Washington Post telling Donald Trump to ignore the haters and keep on keeping on with his policies. But as we're saying, it does feel like we are on an uncomfortable trajectory in terms of fiscal policies. So to what extent do you think investors will increasingly be putting governments on watch? If there isn't a crisis now, will there be a crisis? What would a crisis look like? What are the warning signals?
I think the first thing to do is don't take fiscal policy advice from Liz Truss. The brass neck on some people is astonishing, isn't it? But I think there is a lesson from the Liz Truss debacle, actually, which is perhaps the exact opposite one that she has drawn in that op-ed that you're talking about, which is that fiscal sustainability is as much about investor confidence and therefore the tone and style of communication of government as it is about policy substance. We can sit here and we can talk about the size of the government deficit, and if we factor in assumptions about nominal GDP growth and interest rates, then we can construct forecasts for the path of debt to GDP over the coming years. But critical is that interest rate. And that all comes down to the extent to which investors have some confidence in government. And it can vary wildly, rise sharply, as the Truss debacle showed. That was at least as much about the sense that the fiscal guardrails had come off in the UK as it was the tax cuts that the government was pushing through. It was about the OBR, the fiscal watchdog being sidelined, senior officials at the UK Treasury being pushed out, the bond market wobbling, the government not really taking heed of that and saying, actually, there's even more to come. So it was all of these things going into the mix, and it was like the tone and style of communication, therefore, concerns about the institutional drift in the UK. So don't listen to Liz Truss would be my advice, but learn the lessons from the Truss debacle, which is that the tone, style, manner of communication matter. And this is as much about policy credibility as it is about policy substance.
So it's not just the 30-year at 5% or even 5.5%. It's the path of getting there, not that we are forecasting, but it's the path to which you get there. It's the tone, it's the mood in the market as we rise towards.
Exactly. And shown that you're empathetic to the market's concerns. You're not just dismissing them as abacus economists, I think was the Truss phrase. That, you don't dismiss them, you acknowledge them and you confront them head on. You acknowledge them and you take steps to reassure markets.
Deficits matter after all. I know you've got to go. I want to wrap up this week. I do want to ask you, it's a new week, it's a new podcast episode, but it's an old question. I've been asking every week of late on the podcast, and I'll continue to do so, whether there are any signs that the higher tariffs that Donald Trump has instituted are disrupting global trade.
If we look at the data that we've had over the past week, not so much, actually. I think nothing dramatic, but if you dig beneath the surface, there's a couple of interesting data releases. One is that we've just had a batch of flash PMIs for May. That suggests actually that output price pressures seem to be easing in most parts of the world, but not in the US. So not disruption to trade per se, but perhaps some sense that tariffs are pushing up price pressures in the US, not being replicated so far elsewhere in the world, which is broadly consistent with what we had anticipated. I think perhaps the other interesting development has been in some of the breakdowns of GDP data for Q1 that we've had over the past week or so. In the Eurozone, for example, we've had revised numbers for Germany, revising up GDP growth in Q1 to 0.4% quarter on quarter. Some of that was about the strength of exports, and in particular, the breakdown mentions exports of cars and pharmaceuticals, which might be front-running of tariffs. But another example, too, of business investment being strong in Germany in the first quarter, which I think is at odds from what the consensus would have expected, given lots of talk 2 months ago about the uncertainty generated by tariffs causing businesses to pull back on CapEx plans. So we've now had pretty strong business investment numbers in the US, in the UK, in Germany, and in Spain. So far, not much evidence that the uncertainty caused by tariff and trade policy is causing businesses to pull back. That may come, of course, and I suspect business investment will weaken or soften a little over the course of this year, but it is not collapsing yet, at least in the data.
Neil Shearing there on what the data is showing in terms of tariff impacts and what the bond market is saying about Donald Trump's big, beautiful tax bill and global fiscal risks. On tariffs, Neil was drawing on our Global Trade Stress Monitor, which is an interactive dashboard updated each week to show you where the strains are appearing throughout the global trade cycle, from factory orders all the way along to the end user. I will add that to the show notes. On the Future of Europe series, we've just published another report as part of this wide-ranging project, this time on why increased fiscal spending won't fundamentally improve the German outlook. In the coming week, we've got another of our drop-ins. These are our short-form online briefings in this Future of Europe series, this time looking at whether the repricing of European risk assets seen since the start of this year is sustainable, and by extension, if the US exceptionalism trade is dead. That session is on Thursday at 10 a.m. New York, 3 o'clock London. I will add details to the show notes. Earlier on Thursday, that's 9 a.m. London, our China team is briefing on the latest read of our China Activity Proxy. This is our independent measure of what's really happening in the Chinese economy. The team will also be discussing their new research on the rerouting of Chinese goods in the face of higher tariffs. So plenty to chew on in that session. Register and bring your questions via the link that I will add to the notes. Now, there's been so much news flow on the UK economy this past week that I thought I should catch up with Paul Dales and Ruth Gregory from our UK team. We talked Thursday about the latest economic signals and about Ruth's upcoming work on the problems with UK macroeconomic data. And here's that conversation now. I should caveat this was recorded before the release of that strong April retail sales print. The team's take was that sales were helped by sunny weather and that it doesn't really shift the narrative. Here is that narrative now, and it starts with Paul talking about what we've learned from this week's incoming numbers.
Well, I think what we've learned this week is that we're a little bit more concerned about inflation. We're still just as concerned about weak economic activity, and we're becoming more concerned about fiscal policy and how much tightening will need to be done further down the line. So it has been quite a big week, and that's quite a lot of concerns that's shown up in the financial markets, really, where they're now expecting fewer rate cuts than they previously thought. The conclusion is that, in the market side at least, that the bank may now cut interest rates a bit slower than they have been doing recently.
Our take on the PMI that came out was slower anticipated growth will mean cooler inflation. Talk a bit about how that process is going to play out.
If I could jump to the inflation figures first, I think what we learned from those figures is that inflation was a bit higher than everyone expected, including ourselves. And it's actually really fascinating. It's one of these situations that's perfect for the geeks. You can spend so much time trying to work out what's going up and what's going down and what the net result is. But if you wanted to, you could dismiss pretty much all of that increase in inflation as one-off or temporary factors that you just don't need to worry about. We're a bit reluctant to do that because, of course, this rise in inflation has also come at a time when businesses are paying much higher national insurance contributions, taxes. So some element of these increases in inflation across the board might be related to that, which would give it longer legs. And also, just over the last few years, we know that the lagged effect of inflation has been lingering within inflation and price setting decisions, and there might be some element of that as well. But going back to the PMIs, we did see some interesting easing in the prices balance in the PMIs, whereas the inflation figures themselves made us a bit more concerned about the outlook for inflation. The PMIs eased some of those concerns. I wouldn't say it reversed them completely, but maybe just trimmed some of the upside risks to inflation that we were worrying about earlier in the week.
Ruth, let me ask you, because that CPI report, there was lots of speculation in the press about how much that reflected the impact of the government's tax hikes, specifically on the national insurance contributions. It hasn't been a good week for Rachel Reeves, has it, on net? Where does this leave her? And particularly with all that's going on in the bond market. I know it's in part a global story, but there is a very strongly domestic element to what's happening there.
Yeah, if you look at the public finances figures for April that were released this week, despite the increase in employer national insurance contributions, those figures got the fiscal year off to, I think, a pretty poor start. And as you suggest, there may be more bad news on the way for the Chancellor. Tax receipts are currently benefiting from the fairly strong rise in GDP growth in Q1. But as Paul mentioned earlier, we think that strength may fizzle out in Q2. And so that will lead to weaker tax receipts for the Chancellor. And the Chancellor's fiscal predicament will only get worse later this year. If you look at the rise in borrowing costs and government's borrowing costs, and that inflation print, which has pushed up market interest rate expectations and pushed gilt yields higher, that's chipping away at the Chancellor's headroom. The government has announced pay settlement awards this week, which again could cost around 2 to 3 billion. So again, chipping away at that headroom. And of course, we have heard from the Prime Minister this week about the partial U-turn on the winter fuel payments and the rise in the government's borrowing costs since March following the inflation print, which has pushed market interest rate expectations and gilt yields higher. We think that has probably already whittled away the Chancellor's headroom against her fiscal rules from 9.9 billion to just 5.7 billion. And you can see all of that in our fiscal headroom monitor, our interactive dashboard. So I think all of this really underlines the dilemma that the Chancellor faces over how to deal with all these increased spending pressures in the environment of low economic growth and high interest rates. And I think this raises the chances that if the Chancellor does want to stick to her fiscal rules, then more tax hikes in the autumn budget may be required. And we'll be talking a lot more about this in the weeks leading up to the spending review as well, which is due on the 11th of June.
I want to get back to inflation very briefly, bearing in mind what you say about the April print, perhaps those one-off factors, and then what you're saying about the signals that are coming out of the latest PMIs. Where does that leave us in terms of expectations for the Bank of England? Hugh Pill, Chief Economist, made headlines this week saying that the bank has effectively gone too fast in urging for a more cautious approach. Do you think that's warranted?
I think it's certainly possible, and I think it's warranted to be worrying about the outlook for inflation over the next 6 to 12 months or so. So just to let you know how our forecasts have changed, the figures released for April were higher than we expected. So we have revised up our inflation forecast. Inflation is on April's figures 3.5%. We now think it will peak at about 3.7% in September, which is higher than our previous forecast of 3.4%. So inflation is going to be a bit higher for a bit longer. The big picture in our view is that inflation will actually come down fairly swiftly and at least be on quite a nice downward trend towards the end of this year, going into 2026 and throughout 2026. And we think that's a result of the weak economy, which will eventually weigh on wage growth and feed into lower inflation. So if our forecasts are right, then we still think you could continue to cut interest rates at the pace that the bank has set since last August, which is one 25 basis point cut every quarter. So we are still expecting the next cut to come at the policy meeting in August, and then another one in November this year, and then one early next year. So that would get us down to 3.5 from the current rate of 4.25. But Q-Pill is right. The risks to that forecast, I think, are on the upside. There's certainly a pocket of people on the MPC who are becoming more concerned about the near-term outlook for inflation, and these figures released this week will just heighten those concerns. So August is actually looking like quite a close call. It's almost certain that the bank won't cut interest rates in June. I think that was always the case, but their following meeting in August, that is looking like a close call at the moment. So it wouldn't be very surprising if the bank skipped that meeting and didn't cut interest rates.
It's clear we're in a fog of uncertainty, and what was interesting in Hugh Pill's comments were how much his caution stems from what's happening with wage growth and structural shifts there. And it seems that that would hinge on having a reliable read of what's happening in the labour market. But the UK's official labour surveys are essentially broken, aren't they? Ruth, you've got a report out in the coming week, and it touches on all of this. I've had a read of it, and it's pretty worrying because, at least to me, it suggests that there's far more UK data that may be compromised than most people realise.
Yeah, so there's some well-known issues related to the UK's labour market data, as you suggested. If you look at response rates to the labour force survey, which is used to compile the labour market statistics, that's collapsed since 2019 from 39% to just 13% at its lowest point. And while response rates have since recovered, they are still below their pre-pandemic levels. And this isn't the only long-standing issue. If you look at the migration estimates, because the International Passenger Survey doesn't cover all of the UK's major ports all the time, then the figures were stripped of their national statistics kite mark back in 2019. And obviously more recently, we've had the series of delays and suspensions that have raised concerns that the UK's data problems extend beyond the labour market. I think those well-known quality issues with the UK's labour market data, that might well extend to some of the other UK economic data. And it's possible that with the ONS grappling with funding pressures, there may be further errors. We just might not know about those yet.
And one of the key takeaways here is that for institutions like the Bank of England and the Treasury, with all of these problems with data, the risks of a policy mistake are that much greater, aren't they?
Yes, that's right. I think the data quality issues could have a critical bearing on policy outcomes. If it takes longer for the Bank of England to understand the forces driving the economy, then the reaction of monetary policy could be delayed. And in the current circumstances, that may mean that interest rates are kept too high for too long. And if you low quality data could also lead to unnecessary additional fiscal tightening, so contributing to the UK's low GDP growth problem, or even to fiscal policy being kept too loose, which could result in higher rates of underlying inflation. It could even dent the government's re-election prospects if it leads to a misleading signal on whether the Prime Minister is succeeding or failing in his promise to reduce net migration. So to bridge some of the data quality gaps, we launched our CE UK employment indicator in March, which provides an alternative read on developments in the jobs market and shows that employment growth is not as strong as the labour force survey currently suggests.
All grim news. Shall we try and end on something potentially positive? Paul, the EU-UK deal that was signed at the start of this week, is this the deal that's going to take the UK economy to borrow Boris Johnson's phrase, to the sunlit meadows?
Oh, you wanted to end on something positive. What is clearly happening here is that the UK is moving closer back to the heart of Europe when it comes to issues of security and defence, which makes absolute sense given the shifts in the global landscape in recent years and even recent months. And there is some areas in which the UK is nudging itself back towards Europe on economic issues as well. And that is a positive, I think, from an economic point of view. If we have fewer frictions with our biggest export market, then that's good for the economy in the long run. However, what we need to do is put this in context. And it is the case that the EU reset is really just reversing only a very small part of the trade barriers erected by Brexit. So it's a movement in the right direction, but it doesn't reverse a lot of the frictions that have been put in place by the UK's decision to leave the EU.
Paul Dales and Ruth Gregory on the latest UK macro data flow, the Chancellor's deepening money problem, and that EU-UK deal. Look out for Ruth's report on the UK's data problems. That's coming early next week. I was chatting to her before the recording. We were talking about how the UK and China share problems with employment data quality, but for very different reasons. In both cases, we've launched proprietary indicators to fill in the gaps, and I will link to both our UK and our China employment indicators in the podcast notes. Finally this week, gold prices have cooled a bit since hitting a record $3,500 an ounce in the wake of that Liberation Day tariff announcement in April. The yellow metal has been on an historic tear this year. It's still up nearly 30% year to date, but is the rally over? To find out, I spoke to Hamad Hussain, an economist on our commodities desk, and I started by asking what's been behind this year's price surge.
There's been lots of different drivers of the gold price this year. Some of these include increased investment demand from China, as well as central bank buying. But I think the most important driver, at least over the past few months, has been the events in the US. We had a significant amount of market volatility from Liberation Day. There were lots of fears over the Fed's independence after Trump's comments on Jerome Powell's position. And there have been question marks over the safe haven status of the US dollar as well. All of these factors have been good for gold and led to it surge into a record high of $3,500 per ounce in April.
All right, so prices hit that record. You talk about these factors. I mean, there's a lot to unpack there, isn't there? But just an obvious question, I guess, is does that all drive towards this idea that there is a sort of structural shift towards gold as a safe haven asset and away from the dollar simply because people have just been losing faith in the dollar as this global anchor?
Yeah, I think this question requires a lot of nuance when answering it. I think a lot of people relate sort of the central bank buying aspect of the gold rally to a broader de-dollarization story, at least in the case of central banks. I'm not 100% convinced that the main reason that they're buying gold is because they would like to de-dollarize and move away from the dollar. For a start, lots of central banks have been buying gold, including those at low risk of facing US sanctions. So they wouldn't necessarily be worried about holding large reserves of US dollars, at least. Even in the case of China, it's important not to forget that the dollar is still a large part of the PBOC's official reserves and China's broader financial system. So my sense is that the PBOC is rather using the dollar it earns from China's large current account surplus to buy gold. rather than selling its US assets like treasuries to fund gold purchases, which I think is a subtle yet important distinction to make.
But it is indeed buying gold. Its purchases have increased, right? What is that telling us?
Yeah, I think that tells us more about the value of gold in an era of heightened fiscal, geopolitical, and inflationary uncertainty. I think it's important to know that it's not just, of course, central banks buying gold, but also a lot of investors with long-term horizons as well. And so with the broader macro conditions looking very ideal for gold, this probably paints a very positive long-term outlook for the precious metal.
Okay, so that gets us on to the $64,000 question. Gold's seen this extraordinary rally this year. Prices have come off a bit in recent weeks. Where do you think prices are going to go from here?
Yeah, so I'd split this into two parts. The first one being in the near term, at least the next 6 months, probably, admittedly, they do look a bit more challenging for gold. Our base case is that a lot of the uncertainty around tariffs dies down as a lot of these temporary reductions are made permanent. We're also expecting the dollar to continue regaining a bit of ground that it lost after Liberation Day, not least because we think the Fed will leave interest rates on hold as it weighs up the risk to inflation from said tariffs. All else equal, this would usually point to lower gold prices. But as we discussed earlier on, there are, of course, some of these structural forces which have underpinned the gold rally, not just in recent months, but over the past couple of years as well. And these will continue to provide support to prices. Of course, we've mentioned central banks, but there's also demand from private individuals in China as well. A lot of investors in China are looking to alternatives to the property sector. And given our view that the property sector will continue to slow over the coming years and it'll be a significant drag on the Chinese economy, I suspect that Chinese investors are going to look towards gold as a better store of value and a safe haven. So bringing this all together, I suspect that gold may fluctuate around current prices of roughly $3,300 per ounce over the course of this year. But we think some of these structural forces that I've mentioned, greater Chinese demand and central bank buying, will take the wheel and drive gold prices to record highs of $3,600 per ounce in 2026.
You mentioned before the value of gold, $3,600. Is that expensive? Is there anything historically we can point to get a sense of where the prices will have gone too far if it gets up there?
Yeah, if we put this into real terms, so adjusting for inflation, gold prices would still be considered at record highs. And also relative to other assets like oil and silver, you could say gold appears to be overvalued given those ratios are at record highs too. But it's of course important to consider that there are a lot of structural changes happening within the gold market, as we've discussed. And this perhaps makes some of the historical comparisons less useful, so to speak, in terms of trying to judge what is fair value for gold.
Hamad Hussain on What Next for Gold. He's produced a load of analysis on gold's drivers and where prices are going next. I will link to some of his work in the notes. Hamad will also be on a drop-in with the rest of the Commodities team on June 4th to take your questions about gold, oil, and everything else that's happening in commodities markets. Again, register via the show notes or look at the events page on our website, capitaleconomics.com/events. And to make sure that you get invited to all of our drop-ins, to get access to all of our analysis and to explore our full suite of interactive data, do check out CE Essential and CE Advanced. These are our all-access packages. Get in touch if you want to make sure you're getting the full picture and not missing a trick. But that's it for this week. We will be back next week with much more on the macro markets front. Until then, goodbye.